Hey, listen, if you're a wealthy investor, you could literally be losing thousands, tens of thousands, if not millions of dollars over your lifetime in taxes that you shouldn't be paying. So what are some things that you can do to avoid that? Before I jump into that, I want to take a quick minute and share with you a little bit of my background because listen, there's a lot of people on social media and in the media that are sharing lots of thoughts and ideas that may not necessarily have the credibility or have had the history to share wisely, we'll call it, in this space. So if you don't know who I am, I've had several financial companies over the last 25 years. I've coached over 120 advisors. I've commentated for national media for over 6 years, written for the papers, Wall Street Journal, Forbes, all this stuff. Why do I say that? Not to pat myself on the back, but because over the years of working with wealthy families, literally running other companies right now, helping families save millions and millions in taxes last year. This is the life that I have lived. I believe that we are all stewards of the wealth that God has put into our hands. A lot of you put a lot of hard work into developing the things that you have. A lot of you are at the beginning of putting a lot of hard work into developing the things that you will have. But I do believe that as we grow wealth, and have influence, it's not just financial, sometimes it's influence in other areas. We want to make sure that we steward well the time, the energy, efforts, and the wealth that have been placed into our hands. So one of the biggest things we find oftentimes is there's lots of money that literally falls through the cracks. So let's talk about some areas and places of where you could literally be losing money in taxes that can be corrected if it's appropriate to you. The first thing is holding the wrong assets in taxable versus tax-advantaged accounts. So let's just think about this generally. If you're in a place where you have a couple $1,000,000 or more, there might be an investment structure where an advisor or a person has put you into an investment that is not tax favored for the investment dollar. One great common investment like that is an annuity. Now, I'm not saying that all annuities are bad. I'm not saying all of them are wrong. I'm not saying you shouldn't own one, but I will tell you this. There is a difference between qualified money and non-qualified money. Qualified money is money that's qualified to be taxed. That's often IRA money, 401k money, etc. Non-qualified money, think of it this way, is money that's not qualified to be taxed, meaning the principal of it. The growth is taxable, but the principal is not. And so what can happen sometimes is non-qualified money. Let's say you have $1 million that's in a brokerage account, and maybe it gets put into an annuity. Well, that annuity now is growing in a tax-deferred manner, meaning that you don't have to pay taxes every year on your gains. But you do have to pay taxes on your gains when you take them out. That doesn't mean always that that type of an investment is a wrong or bad investment for you. You have to check your situation, but it does mean that if you put that money in that investment, now it's taxed at an ordinary income rate. Again, not always a bad thing if you want to use it as protection, and that's your main focus. But you just need to pay attention when you look at your investments in general, and that's one simple example of where you say, okay, do I and am I investing my investments in such a way that it's maximizing a taxable versus a non-taxable account? That can make a massive difference long term. Just imagine it this way. Let's just say your investment has the ability to be taxed at capital gains rates, which is typically 20%, versus being taxed at ordinary income rates. Now, based on your ordinary income, if you have a high ordinary income, it could be up to the federal max, which could be right now, as I'm shooting this in 2025, 37%. And if you don't live in a tax-free state, in addition to that, you'll have state taxes that are added on to that. You could literally be paying 45, 47 or more percent in tax on gains as you take them out. Whereas you could put it in another investment that you're only paying capital gains taxes, much, much lower rate. Now, there's lots of tax planning that can be done to mitigate or eliminate in some ways, or reduce in some ways, taxes on those investments. But this is just something that you need to be thinking about in the beginning. All right, so let's talk about the second thing that can happen sometimes where you're kind of leaking or losing money down through the cracks. Not harvesting losses, managing gains proactively. This is so important. You know, a lot of times people are in a place where they have investments and their main focus when they invest money is they just want to grow. But what they're not doing is taking advantages of some losses along the way. Let me give you a simple example. Let's say you purchase a stock and that stock goes up 20%, right? And you didn't sell it. The question is, did you keep that gain? No, you didn't. That gain right now is just a paper gain. And let's say that stock decides to to lose a little bit of money. And now all of a sudden at the end of the year, you're in a situation where you didn't take advantage of some of the loss in selling it to keep some profit, but you're in a place where you manage and harvest out, it's called tax loss harvesting, gains and losses in your portfolio. So you always want to be looking at different positions, equity, ETFs, mutual funds, whatever. This is a conversation that you want to have without getting too deep into the weeds. You want to be talking about this with your advisor. If you have an advisor, if you don't, you need to be thinking about that. What am I doing to maximize tax loss harvesting in my portfolio? As certain things have gains and certain things have losses, what can happen is they can wash out the tax bill that you may have at the end of the year. Very, very, very important. Also, if you're owning an equity position, are you in a place where you're keeping it longer than a year? Or are you selling it in between the year? Because if you sell in less than a year, you're going to have short-term gains, which are going to be federally taxed instead of capital gains tax. All important things to think about. Now, keep in mind, this is not the end-all be-all as far as taxation on your portfolio, but these are important starting conversations. From here, you move down the path of advanced tax planning, where you're getting into strategies maybe like oil and gas, where you participate in intangible drilling costs, or utilizing cost segregation strategies, advanced depreciation strategies, and a variety of other strategies that can literally help you significantly mitigate your tax bill. Very important. Another thing that you want to be thinking about, third on the chart here, is overlooking the idea of charitable and legacy strategies. So what are you doing with your wealth currently to ensure you're maximizing your charitable strategies along the way? Here's a quick, simple example. Let's say you bought a car and you've owned that car for a while, and then one of your children or grandkids drove the car and it's just kind of sitting around. It's just there. What if you took that car and donated it to a charity that could use it well, and now they can give you a receipt and you can literally take that car and get it as a charitable deduction? There's other strategies that you can use. In one of the other companies that I have, Wall Private Capital, we participate in not only mining, but the potential, if voted upon, to have significant tax advantages as well. Sometimes a 5-to-1 multiple. Again, just depending on the structure. What does that mean? For every dollar we put in, there's an opportunity, if the investors vote on it, to have the ability to have a 5 times deduction. So in other words, you put $1 in, you get $5 in tax deductibility on your ordinary income. One of the things that can really supercharge your giving for charitable organizations is actually, before you give to a charitable organization, take a look at some of the advanced tax strategies that might be available out there. Obviously, you have to first decide whether or not they're appropriate to you. Most of these are for accredited investors only, which means you're making a certain amount of income or have a certain amount of wealth. And you take advantage of maximizing your tax deductions along the way, so that way, ultimately, you save more in taxes. And oftentimes what we see is you're able to give more to charitable organizations that actually need it for their day-to-day operations. So just paying attention to what you can do along the way to maximize not only what you're giving, but how you're giving, and save more for you and add more value to the organizations you're giving money to. It's so important. It's just things that are missed because people are so busy, I think, in life sometimes, that they miss out on maximizing their structure. So I'm going to give you an example of a client that literally ended up for the Wall Private Wealth Company, so different hat, but a client that we saw that literally sold a company and was in a place where they were going to have a massive tax bill. But because of some of the strategy that we implemented, not only did they not pay millions of dollars in taxes, they literally saved millions of dollars in taxes, and they were able to take some of that money and give it to charitable organizations that needed it, which helped them with day-to-day needs. But they also were able to take some of that additional capital and use it from an investment perspective to help build their wealth in the future. Now, this is really important because it's not just about, remember, making money, but it's also about saving money in taxes. Remember the old adage, which it was said long ago, there's 2 things in life that are absolutely certain: death and taxes. This is something that's huge, and I really want to challenge you to think about the idea of how do you audit your personal financial private wealth situation, family office, whatever it is, to ensure that you are maximizing your tax strategy, your tax savings, your efficiency along the way. There's many more advanced strategies that can be discussed here. Again, these are things that you need to know about, and a lot of people don't know what they want because they don't know what's available. It's one of the reasons the company that has sponsored this show, Wall Private Wealth, I founded years ago, that's helped families protect, grow, and reduce taxes on their wealth, have sponsored this show because there's a lot of great strategy with the team members over there that can help you, if it's appropriate, maximize your wealth and really minimize what you end up paying in taxes. Ultimately, so you can be a better steward and use what God's put in your hand to help many out there do things that maybe they couldn't if they wouldn't have got the donation from you. Think about that. Be blessed. Check them out. If you got questions, and comment on this show for more information that you'd like to hear, or things that you'd like to hear, or topics that you'd like me to cover. Be blessed, and we'll talk to you all soon.